So we'll just go through some of the more material changes that affect individual taxation. Um, this just compares the brackets that will be in effect for 2018. They still ended up keeping the 7 different brackets, but obviously lowered the rates and then made some changes now that the top rate goes from 39.6 to 37%. And that's for the 37% is income over 500,000 single or 600,000 married filing jointly. The standard deductions have all been increased, and then the personal exemptions have been repealed. So with those 2 changes, the intention is that a lot less people are going to be itemizing going forward. And the personal exemptions, the intention is that the increase in the standard deduction will cover that, as well as increases in the child tax credits for families, which we'll get to. The kiddie tax rules were simplified. That's for any children you have under the age of 17 or 20, students under the age of 24. Prior to this, they had to, if they had any significant unearned income, that was taxed at the same rate as their parents. Now they're taxed at the same rates as estates and trusts, so their tax rates are no longer dependent on their parents or their siblings. So for people who still can itemize, there will be some changes to the itemized deduction thresholds and limitations. The medical expenses now are allowable once you get over 7.5% of AGI as opposed to 10%. The state and local income tax, including property tax limitation, is now capped at $10,000 as opposed to the unlimited that it was before. The law splits the definition of home mortgage interest into 2 categories. There's qualified acquisition debt and then home equity indebtedness. You can deduct interest on acquisition debt up to $750,000, which it used to be $1 million, and now home equity indebtedness is non-deductible. There is thought to be some clarity needed about what's defined as home equity debt. You could, if you took out a home equity line to improve your property, that could fall under the definition of home equity or of acquisition debt. So that would still be deductible, but if you took out a home equity line to pay for college tuition or something else, that interest won't be deductible anymore. The allowable amount of charitable contributions is now 60% as opposed to 50%. All of the miscellaneous itemized deductions have been repealed, so that includes unreimbursed employee business expenses, accounting fees, itemized investment expenses as well. Also, the phase out of itemized deductions has been repealed. Prior, if your adjusted gross income got over a certain level, your deductions were reduced. That's now gone. And the deduction for casualty and theft losses are now gone unless you are in a federally declared disaster area. So the child tax credit has been increased to $2,000 per child. It was $1,000. They also increased the limit for the phase out. For married filing jointly, it's adjusted gross income of $400,000. For a single, it's $200,000. So that means a lot more families are going to be eligible for this credit because the phase outs before that were $110 for married filing joint and I believe $75 for single. So that's a huge increase. There's also now the new non-refundable $500 credit for dependents who would not qualify as a child. So that could be an aging parent that you're taking care of or a child who's over the age of 17. The alternative minimum tax for individuals was not repealed, but they did increase the exemption amount and the phase out significantly. And that combined with the changes to the itemized deductions and capping the taxes, which was usually one of the bigger add backs if you were subject to AMT, means that a lot less people really are going to be subject to it. They've doubled the estate and gift exemption amounts, and they've retained the step-up in basis for inherited assets. I just have a quick example here. So this would be a couple that's married filing jointly with 2 children that would qualify for the tax credit, or the child tax credit, with $250 of wages. And the most common standard or itemized deductions that you usually see, some state taxes, property tax, mortgage interest, and charity. So in 2017, they would have allowable itemized of $31,500 and an exemption of $16,200. So they'd end up with taxable income of $202,000, and they would have AMT taxable income of $237,000. They would have regular tax of $43,529, and then they would be subject to the alternative minimum tax as well. So their total tax would be $44,000 or $45,000. They would not be eligible for the child tax credit because their income is over the old threshold amounts. In 2018, their allowable itemized would now be less than the standard deduction because of the cap on the state and local property taxes. So their taxable income will go up to $226,000, but their AMT is under the threshold amount, so they would no longer be subject to that. So they'd have regular tax of about $43,000, but they would get the child tax credit now of about $4,000. So their savings, there is some savings with the lower tax rates for them, but also there's the $4,000 credit is where their biggest savings would come in. And that's just one example. I mean, it's tough to say. There's no typical, family or income level that you could say that everyone's going to have this kind of same result. But hopefully, this is a good result for most families that have at least 2 children that have that child tax credit that they couldn't take advantage of it before. And then just a few other miscellaneous things. The moving expense deduction has been repealed. The alimony income and recognition and expense for the recipient has been repealed for divorce or separation agreements entered into after 2017. And the individual insurance penalty has now been eliminated after 2018. The student loan interest deduction was retained, as were the $250 of unreimbursed expenses for teachers. The 3.8 net investment income tax survived. And there was some talk of making some changes to the gain on your principal residence when you sell that. None of those changes happened. It's still, you have to live there the 2 out of the last 5 years, and you can exclude up to $500,000 married filing jointly of any gain that you might have. The college credits survived, and the preferential capital gain rates also survived.